They all tell you to just buy the dip or snipe the rally, making it look so easy. And then they proceed to blow smoke up your ass by pushing more nonsensical drawings and subjective TA patterns that they themselves could not consistently pull a profit out of to save their lives. But in the end, the inevitable always happens. The market suddenly takes off, leaving you in the dust waiting for a pullback that never comes, and you find yourself FOMOing at the top. Or a nasty dump unexpectedly comes raging and you're left holding the bag and rationalizing your way into huddling despair on Reddit. If that sounds familiar, and if you're done with bro science requiring confusing spur-of-the-moment input that cannot be replicated, then welcome. I've got something very different for you. The video that follows will provide you with an objective proof of concept of a clear trading system that you can test and tweak to your own risk aversion, with tangible rules that you can actually follow, and profitability that you can indeed verify. Whether you decide to trade it as is for real results or as a validation tool to supplement one of your favorite strategies, there will be something for everyone. No price action BS guaranteed. So turn off your phone, grab yourself a cup of coffee, and let's give quantitative trading a go to turn your crypto investing around for good. Let's get to work. Before we move on, I want to clear up the air and address the horde of elephants in the room. First things first, it needs to be reminded that even though this trading system has provably been profitable historically and will very likely still be so in the future, I cannot guarantee that it will keep working as well going forward, or at all for that matter. So deciding to trade it with real money remains a responsible adult's decision and yours alone, which is also why I strongly encourage you to quantitatively verify my claims. Also, in order to make it accessible to everyone, I purposely streamlined it to make it as simple as possible, but not simpler. Meaning that if you want to trade it, it will not be a casual endeavor reading Fibonacci tea leaves or dreaming up price waves, and actual work will be required from you to make it work. For once, you're not being promised instant gratification or something for nothing. Imagine that. Further, even though I will be upfront and will openly disclose every single rule and inner workings for you to verify the system's profitability, I also understand that not everyone can or want to code. So I put together a foolproof, micro-enhanced Excel model that everyone will be able to backtest and calibrate the system with to their liking. But I will charge a lazy tax for it. So basically, learn to code and figure out the system for free, or pay someone who did it for you. And for the entitled commies out there, that's the novel concept of charging for work done. Check it out, it's mesmerizing. And lastly, the burning question: why the hell would I disclose a profitable trading system? For 4 reasons. First, this system is an older system of mine that I am only trading alongside another, better performing and more sophisticated one. So it's no biggie to my bottom line to share it. Second, my subscribers know that all of my systems are grounded in math and are therefore not optimized, meaning that most parameters work very well alongside their own risk-reward profile. We will therefore not risk tripping over one another by chasing the same pockets of liquidity. Third, I know all too well that crypto has become the escape door from the rat race or straight up poverty for a lot of people, and getting wrecked has pushed a lot of them back into it, into accepting government mandates or corporate blackmail and making atrocious and irreversible health decisions for themselves and their family, and that sickens me to the core. Hence why I want to give away a workable frame of reference to help people manage their trading risk. And fourth, a very selfish reason. I am quite honestly tired of people letting themselves being led on by phony gurus and channels out of intellectual laziness, systematically getting their asses kicked by the market for it, then hypocritically proceeding to claim that they didn't know and plead for help from daddy government to protect their immature selves, which will invariably result in all of us responsible traders getting our business freedom stifled for it with more regulations. So here is your opportunity to achieve tangible trading results that you will work for and be proud of. No more excuses. So if you're okay with these rules of engagement, then let's proceed. Here is the value that you will get from this system. As you will discover, its logic is very simple but equally robust. While seasoned traders might use it as a primer and take from it a few basic concepts to complement and upgrade existing strategies of theirs, novices will most likely find in it a much more reliable or maybe the first real testable strategy that they ever found online. How do I know that? I just need to look at the big crypto channels, their absurdly high subscriber count, and watch how the crowd is welcoming their spilling out dubious subjective patterns upon anecdotal evidence for hours on end. So if you're transitioning from that kind of content, you're in for a big change. Whatever the case may be, because the rules are so simple, they are unlikely to interfere with most rules that you may already be using, and I would strongly encourage you to take them apart to test what positive effect they could have on your expectancy. Now, technically speaking, here's what you can expect this trading system to help you accomplish. Obviously, not many outcomes can be guaranteed in trading. However, it still is possible to tweak quantitative logic to ensure that it deals in absolutes when it comes to certain algorithmic behaviors. And it will become very apparent as you learn about the system's logic. In this strategy's particular case, it will allow you by its very design to never miss a steep multi-week price surge or a bullish turnaround ever again. Now, does it mean that there won't be any false positives or that you will be able to catch 100% of the movements from bottom to top? Absolutely not. But surges like the 2020 rally, for example, the vast majority of this system's algorithmic configurations would have allowed you to ride most of it. Turning from the reward side of things to risk management, this quantitative strategy will also give you a good clue of when to bail before a full-fledged bear market kicks in, and even sell near the top in most cases. Not a bad feature to have, especially since you will not be using a vulnerable standing stop loss order sitting on your broker's order book ready to be harvested by a rogue price spike. Another technique will be used instead. Because the system is not optimized, both the entry and exit logic are also transitive to virtually any coin, albeit with varying degrees of success, which is what should be expected from a system which rules were not statistically brute forced into existence. And I know a lot of you will enjoy the fact that you will be able to trade shitcoins with it much more efficiently while taking away most of the risk of getting totally obliterated. The design of the system is extremely straightforward and only makes use of two parametric inputs. Because of that, it is fairly rudimentary and not all-encompassing from a price motion dynamic standpoint, but it does the job to capture enough of it to generate consistently positive expectancy. The purpose of both inputs is to 1. Describe and detect initial momentum for entries, and 2. To spot rising inertia for exits. The system was initially developed on Bitcoin using daily closing price data ranging from October 6, 2013 through January 19, 2022. And as with any system presented on this channel, profitability is entirely non-parametric as parameters are only used to dial in or out the system's performance as relates to its risk-reward profile. To illustrate that feature, let's take a look at the Bitcoin parametric density. This 3D chart shows the net percentage compounded P&L on the vertical axis, with each horizontal axis describing the parameter values for both the lookback used to declare a valid momentum upon entry and the number of days used to validate rising inertia upon exit. Two things can be spotted here. This side view shows that the P&L is fairly distributed up to a certain degree alongside the inertial scale. That's all fair and good, but even if this second view demonstrates that all combinations do make money, as expected, some do make much more than others early alongside the lookback scale. So that should lead you to believe that some combinations are better than others, and that those on the right should be discarded altogether, right? No, you would be wrong, and most of my subs already knew the answer. We'll go back over this aspect later. Alright, so now you get how the system is organized and what you should expect from it. Let's delve into the actual trading rules. As I said, what follows are all the rules required to make this system work. Nothing's been withheld behind a paywall or left out to be released at a later date. To best illustrate the entry and exit logic, I will intentionally use a cherry-picked example every time, one that is crystal clear to understand. Note that this does not qualify as anecdotal evidence, as none of these examples are portrayed as proof or even clues of the profitability of the system, but merely to show how the rules should be applied. Also, I will focus on the long side of the system in what follows, and all that you will need to do for the short side of the logic is to diametrically reverse the rules. Let's start with the entry logic. Here we will use a higher high breakout on close. What is that? Let's imagine that we use a look-back value of 30 for 30 days. Then our entry signal will be triggered once we get a close that is higher than the preceding 30 daily closes. Here is how that would look like on a chart. Never mind the candles, by the way, they are only shown to help you understand how it all works, but visual patterns should be 100% irrelevant to making your decisions. This is quantitative trading, and all that we care about here are the values. A mere spreadsheet should suffice to declare what action should be taken. The yellow line here is the trigger line that is recursively dragging the higher close based on your chosen look-back value. In this example, we are dragging the higher close of the past 30 days. So basically, as soon as this line is incrementally pushed higher by your latest close, and assuming that you have no open position before it does, that is when you should buy the close. In this example, we can clearly see a potential initial buy signal right here, or another one right there. etc. If you're good with this, let's move on to exits. We want to look for rising inertia or waning momentum in order to get out. To do that, we need to remember how price is moving. Quite obviously, it can go up or down, but especially, it not only can but will go to the right according to our chart's horizontal axis, which is time. Detecting rising inertia can be done fairly easily by combining elements of vertical price change with the pace at which it does so over time, meaning alongside our horizontal axis. Now here's where our second parametric input comes in. We know that we have elected to use days as a discrete increment to break down and measure time in this system. So our second input will be a day count. Here's how it works. Our counter is initialized to 1 as soon as we get a higher close that meets our momentum trigger and we enter the trade at the close. Then, in order to gauge rising inertia, we will start incrementing our counter by +1 for every consecutive day that we do not get a higher close from the previous higher close printed since our entry. But every time that we do get a new higher close within the time threshold that we allow for the price to resume its initial thrust, that counter is reset to 1. The trade will be deemed to have lost its valuable momentum and should be exited when that counter overshoots by 1 day our allowance for consecutive days that are not displaying any sustained momentum, or put differently, for those consecutive days where closes are not printing a new higher high since our entry. If I lost you already, let's turn to a picture and zoom in on our previous trade entry example. Assume here that our entry parameter remains the same at 30, but our exit parameter has been set to 5, making our parametric combo 30 and 5. Right here, on the first higher close than our trigger line, we initialize our Y parameter to 1, because it is our first higher closing day and a breakout is occurring. Remember, setting a max value of 5 for Y means that we allow for the market to not give us a higher close for 5 days in a row. In other words, we would leave ourselves up to 5 daily closes in total, including the latest higher close, before we exit at the close of the 6th day, provided that this 6th day is not a higher close, of course. By doing so, if the price keeps getting higher, then we ride the search for as long as the market gives us exploitable momentum. So back to our trade. Are we getting higher closes? Whenever that's the case, then we do not increment the value by 1 and it remains 1. Whenever it's not, we do increment it by 1 and the counter becomes 2, 3, and so on. Here, as you can see, we are not getting any higher high for 5 days in a row, so we increment the Y counter up to 5. But on the 6th day, we are getting a higher high. So we reset the counter to 1 on that day, and so on until inertia becomes overwhelming and we need to exit the trade on the 6th day. Absolutely feel free to pause here to carefully observe the trade and how it was managed by the system. This one was a gain, but the next one was a loss. So try to rerun how these trades would have played out until you understand the gist of the system. Now let's take a look at how backtested results would look like and how our system behaves from a parametric standpoint. By the way, all the results that follow account for a comfortable 1% in trading costs to cover commissions, spread and slippage, which is reasonable without being overly conservative. For the sake of demonstration, we will pick two extremes such as 10 and 3 and 190 and 18. Starting with the very active 10 and 3 configuration, across 145 trades we can observe a very high CAGR of over 76.8%, paired with a steep max drawdown of -42.8% and a relatively low profit factor of 2.99, making the risk-reward profile not overly compelling. Clearly, this is a very aggressive configuration. Moving along to our next settings of 190 and 18, first off, the trade count falls drastically to merely 18, and our win ratio ramps up from 44.1% to 61.1%. This time though, our CAGR drops significantly from 76.8% to 48.5%, but our max drawdown is cut by about a third to -31%, and our profit factor jumps to a whopping 9.59. That's a clear shift to a much more conservative configuration here. The point of this quick comparison is to show you that despite profitability remaining high across the board, the reward to risk profiles can vary by orders of magnitude from one setting to the other, and should therefore be carefully picked depending on your risk aversion and your return goals. Hence why you should never ask the newbie question, but what are the best settings ever again? If you only have to take one technical notion away from this video, please let it be this one. With a system grounded in math, there can be no so-called best settings, since it is not meant to be optimized by design, because it does not need to be. And if it so happens that there are supposed best settings indeed, it only means that your system is a brute-forced, statistically curve-fit piece of trash that belongs in the dustbin of your trading arsenal. Don't trade it. Now, if you really want to talk settings, there is a right way to do it. What you need to understand once and for all is that there will never be a one-size-fits-all setting, ever. And this is where portfolios come in the picture. If you wish to get a technical head start and get a deeper understanding of what we're going to do now, you may watch this course, link in the top right, which goes in depth over the concept of decorrelation and portfolio building that should be made extensive use of with this system. In order to achieve vertical decorrelation specifically, you will have to stack a few combinations of systems that can predictably generate materially different reward to risk profiles depending on the settings used. But before you do that, you must have generated the entire density maps of parametric behaviors for such metrics as net P&L, max drawdown, profit factor, number of trades, MAR ratio, etc. From these views will emerge a clear picture of what parametric levers should be acted upon in order to obtain the desired synthetic behavior that is blending all of your systems within a single algorithmic portfolio. Let me give you a real-life example. This is an equally distributed allocation of 4 systems with their own parametric settings. These are their individual stats, and this is a graph charting their combined equity curves within a portfolio. Now here is what the average risk-adjusted stats should look like assuming zero decorrelation effect. But here is what the vertical decorrelation magic allows you to achieve. This is what is being portrayed by the equity curve, a portfolio that is better than the sum of its parts. This type of blend is what you should strive for, because once again, no single system will work best all the time. So one last time, for the love of God, snap out of this what are the best settings mindset. This is what causes you to look for all the wrong things in systematic trading. Let's move over to another crucial way to gauge the robustness of our systems through transitivity. In other words, can we transpose the system over to another cryptocurrency with great results without optimizing at all? To that effect, we will use a cryptocurrency with an historical time series comparable to that of Bitcoin, even if a bit shorter. So let's see how our algorithm holds up against Ethereum with the exact same parameters, whether that is for each one of the 4 systems individually or consolidated as a portfolio of systems. Our data was stretched from August 7th, 2015 through January 19th, 2022 on this one. That's 2,353 rows of daily data. Here are the stats for each individual system along with their equity curves. Remember, all that we did was throw Ethereum's daily closing price data at the exact same parameters that we used for BTC without tinkering with any of them in the slightest. And here are the consolidated stats with their average and a comparison of that average versus the portfolio of systems with its own consolidated statistics and its equity curve. Same decorrelation and same beneficial effect. As you can see, not only does it work, but it in fact works even better, and unsurprisingly so, without resorting to any optimization whatsoever. Now, I have not tested it against all coins obviously, but I can show you a snapshot of the same portfolio on Cardano, for example. I think you get my point already. It may be more or less profitable depending on the bullish dynamics of the coin, but in the vast majority of cases, it just works. And most importantly, it saves your ass from holding the bag into massive dips. So here we are. You have now been given a real trading system to turn your trading around, not some chart drawing opium pushed by shameless clickbait artists. Over 40 hours went into making that video, and I really hope that you could take away a lot of value from it. However you want to put this system to task, I am urging you to do one thing before doing so. Test it. You have to extensively test what you're going to trade 100% of the time. Please do not trust me and verify this system yourself. And when you're done doing so, hold all the YouTube clowns out there pushing vague theories on you with the same level of scrutiny. Now you know the system's rules. This is where the real work begins. You now need to find which crypto asset to trade, which system settings to use, and possibly which portfolio to build. Coders are gonna have a blast exploring this one. But for the others, you're not out of luck. I have put together a one-click solution in a comprehensive Excel workbook for you to backtest this system on all kinds of cryptocurrencies in whatever way you wish. The workbook comes with a PDF tutorial explaining step-by-step how it all works. You will be able to backtest any parametric combination on any coin or asset that you like, create the matrix of parametric density, build a portfolio from it, and make your first steps into quantitative trading. The link can be found in the description down below or directly down in the resources section of the FX Physics website. One last word of caution for you. You have to keep in mind that no system is perfect, and even an elegantly simple and streamlined system like this one still has limitations that a more sophisticated eye will be able to spot, and so should you be aware of them as well. Here are the most glaring 3 flaws that I can think of. First, cryptocurrencies are a fairly young asset class, and no matter how successful the system's history and how mathematically sound the algorithm logic is, the statistical load used to validate it remains extremely underwhelming, both in absolute and relative terms if we compare it with equities, which available price history has been running for decades, for example. Second, what this model does not show here is the continuous drawdown. The calculations performed in our test were made on a close-to-close basis, meaning that this is the minimum drawdown expectable since it does not show the actual drawdown happening between the opening and the closing of a position. As a rule of thumb, I usually expect the actual drawdown to be about 30% higher than the close-to-close assessment. And third, the system clearly thrives on high directional volatility. And the older cryptocurrencies get, the less speculative and the less volatile they should become, which implies that the best days of the system might possibly be behind us. And even if profits can most likely still be made in the future, they will likely decrease in magnitude over time as the crypto world matures. Always remember, trading is nothing but risk management, and if a strategy cannot be proven to you quantitatively, then assume that it does not work. Period. If you like this video, don't forget to give it a boost for the YouTube algorithm and consider subscribing for more evidence-based trading content like this one. I wish you all to turn your trading around with what you learned today. No more getting wrecked. I'll see you in the next video.